The vast majority of investors, whether they're at Schwab or anywhere else, haven't lived through a bond bear market.
Yes,
they haven't seen one since the 70s.
Very true.
What do you expect them to do once they see the losses in their bond funds or ETFs?
Yeah. Well, of course, it remains to be seen how far interest rates go up and how fast they go up, right? And that will dictate the extent of the losses.
But they'll lose money. If interest rates rise, they will lose money.
Certainly in bond mutual funds, they will. If they're holding individual bonds, they can hold that bond to maturity and get their principal back. But in fairness, people don't talk about the yield they'll be earning in the meantime if they hold that bond is less than what market yields would be on new bonds. It's a big issue. It's a concern. We try to do a lot of education with investors around what it could mean in a rising rate environment. Here's what won't work. What won't work is the thought, well, I'll get out before it happens. That won't work. And unfortunately, that is something we hear from some investors, and that's not a strategy for success.
So even if, in principle, it doesn't work, do you think all the same we're going to see a stampede out of fixed income, whether it's in Schwab accounts or elsewhere?
It all depends on, again, the pace at which rates go up and how far they go up.
You think it's a real risk, though?
If they eke up as they sort of are now, I don't know that you'll see it. If you see rates jump 200 or 300 basis points in the course of 90 days, you're going to have a bit of panic among some investors.
What about the inevitable correction or perhaps bear market in equities? Because it is going to happen.
It's coming.
We don't know when. Maybe you do.
I do not. I thought maybe you might, but I don't.
What happens then? How do you expect investors to behave then?
Well, as we all recognize, you've got to be diversified. And if you are not diversified, you're basically playing the game, right? And at this point where the stock market is, arguably you're picking up nickels in front of a steamroller because the market is, by virtually all measures, at a fairly high level. So you got to be diversified. You got to be balanced with your stocks, your bonds, your cash. You got to have a portfolio to withstand it.
Firms like Blackstone, Walt, have big ambitions for the businesses they can build in retail. What's your view on the suitability and the cost of alternatives for individual investors?
The track record of most alternatives, without picking on any individual firm, is not great. Now, there are firms, just like in the active asset management space, who are very focused, generally have a lot of experience, who have delivered alpha, who've delivered outperformance, but they're few and far between. In general, I'd have to categorize alternative investments as probably not a great deal for most investors. If you get lined up with one of the exceptional firms, just like again on the active asset management side, you've got a fighting chance to get outperformance.